Welcome back, everyone. This is Ethan, CFA Charterholder and investment professional, and today I'm going to take you through the ultimate retirement income playbook. We're going to go through the pros, cons, and roles in a portfolio of every major retirement income strategy: covered call ETFs, high yield bonds and their various flavors, business development companies or BDCs, REITs or real estate investment trusts, and dividend income funds. Let's dive in. I think it's helpful to think of these things along a spectrum. Of course, everyone wants the highest income possible, but like anything in life, there are trade offs. Usually, in order to generate a higher income, you either have to take on more risk, give up long term growth potential, or both. And both is bad, but we'll get to that shortly. As we go through these, the key thing to keep in mind is that the number one most important factor when building a retirement income strategy is long term sustainability. The prices of the things that you need to buy will go up over time. So, unless you only plan to be retired for a few years, you need to create a growing income stream. If you don't, eventually you just won't be able to maintain your lifestyle. Simple as that. Let's start with covered call ETFs. I'm not going to spend a ton of time on this one because I've already done a lot of videos on these, but here's the short-ish version. In a nutshell, a covered call ETF buys stocks, then writes or sells call options on them. A call option gives the buyer the right to buy a stock at a set price. Of course, they'd only want to do that if the stock price were higher than that set price. So if you're selling those options, like these ETFs are, that means that someone else gets to benefit from the upside in the stocks if they go up a lot. So to recap, covered call ETFs buy stocks, then sell call options on them. That means you, as the investor, get a little upside potential, but then anything beyond that set price, which is called the strike price, you give up. And what do you get for giving up your upside potential? A juicy yield. And that is the main reason people buy covered call ETFs. On our spectrum, most of these would be among the worst options we'll talk about today. Of course, like every broad category I plot out in this video, the strategies inside are not all the same, so it's only meant to be a loose, sort of midpoint representation. But in general, with respect to covered calls, the more concentrated and risky the underlying holdings, and the more of the portfolio that they write covered calls on, the higher the yield will be. And also, the less sustainable it will be over time. At the extreme, you have the single stock ones, then the concentrated tech ones, then the broad market ones, then the lower volatility ones. As you go down, you take on less risk. So you get less income and create a slightly more sustainable income stream, but covered call strategies in general are not that conducive to long term sustainability. The only ones I think can create a long term sustainable income stream are the ones that take a lower volatility approach and only write covered calls on a small portion of the portfolio. Diva would be an example of one of these. So there are exceptions, but the vast majority of covered call ETFs, in my opinion, are likely to get crushed in the next stock market downturn and have a very difficult time recovering. That means your income may seem great now, but there's a good chance it will go down over time. The opposite of what we want in a long-term retirement income strategy. By the way, all throughout this video, I'm going to assume you're taking the dividends in each of these investments instead of reinvesting them, since we're talking about generating an income stream here. The next area we'll cover is high yield bonds, including many different flavors that some people would consider to be separate categories, but we'll touch on them all here because they're all related. All of these, in one form or another, are lending money to high risk companies or governments. When you lend someone money, you want to get paid back, right? And the less likely you are to get paid back, the higher the yield you're going to demand to lend someone money. So usually, if you're comparing two different high yield bond funds, the one with higher yield is taking on more risk. Another important consideration is that some of these strategies have a lot of downside potential and behave more like stock funds than traditional bond funds. This is especially true with regular, traditional, high yield bond funds, which mostly lend money to risky companies. I would think of these as generally less risky than the overall stock market, but exposed to a lot of the same risks. Think about it. If the economy is doing well and profits are up, stock prices are probably up. And if profits are up, It's also easier for companies to pay back their debt. So high yield bonds usually do well in that environment too. It works the opposite way. If companies are not doing well and profits are down, their stock prices usually go down, and so does their ability to pay back their debt. So high yield bonds usually go up and down along with the stock market. The reason high yield bonds are usually a little less risky than stocks is because if a company goes bankrupt, their assets will be sold off for whatever they can get for them, and their stockholders are usually last in line to recoup any of their investment. So often, what will happen is the stock goes to zero, and the bondholders get, say, 40% of their investment back. Still a huge loss, but often not as big as the one that the stockholders will take. The yield, risk, and attractiveness of high yield bonds at any given time can be determined by the spread, which is the additional yield you're getting on top of the current treasury yield. When it's higher, there's more perceived risk in the market and you're getting more yield. I actually find that to be the most attractive time to invest in high yield bonds. It feels the worst to invest in them there because you'll probably be inundated with headlines about whatever the market is most worried about and fears about how much worse it can get. But with a 5+ year time horizon, this has usually been the best time to invest in high yield bonds. So, looking over at the bottom right, you can learn two things from this chart. One, spreads are about in the 3 to 3.5% range. And since treasuries are yielding around 5%, a lot of high yield bond funds right now are yielding in the 8% range after expenses, depending on how much risk they're taking. Two, spreads are pretty low relative to history. That means that the market is complacent about the risk in high yield bonds right now, and you're really not getting paid very much to take it on. For that reason, I don't consider high yield bonds to be particularly attractive right now, but in general, they can be a solid component of a retirement income strategy. The other flavors offer a few nuanced differences. First, high yield municipal bonds lend to risky state and local governments instead of risky companies. There are four important takeaways for these. First, they offer a lower yield, sort of. On the surface, it'll look that way. This happens for two reasons. One, they're less risky. Sure, it's possible for local governments to go bankrupt, and it has happened before, but it's a lot less common than it is with risky companies. Two, they're often exempt from federal income taxes and sometimes also state income taxes. So, for example, if you're in the 40% tax bracket, then a 5% yield in a municipal bond would be the equivalent of an 8.33% yield on a taxable bond. The final thing to point out with high yield municipal bonds is that they're much less correlated with the stock market than any other high yield bond options we've talked about so far. That means that they're a better complement to the stocks in your portfolio because when the stock market goes down, it doesn't have as direct of an impact on the finances of states and local governments as it does on companies. For high earners in a taxable account, I think these are an excellent addition to a retirement income portfolio. Next, we've got emerging market bonds. This is lending money to risky countries instead of risky companies or state and local governments in the US. Emerging market bonds generally have a pretty similar risk profile to regular high yield bonds, but both can have a wide range depending on who they're lending to. I might think of this as like adding international diversification to a high yield bond portfolio. Sometimes they'll do better or worse than US high yield bonds. Sometimes they'll have higher or lower yields, but both can be used together as risky, high yielding components of a retirement income strategy. Next, there are bank loans, also known as leveraged loans, which are usually risky floating rate bonds. Some people consider these to be slightly safer than traditional high yield bonds because they're a little higher up on the capital structure, meaning they get paid back first in the event of a bankruptcy, but they're still lending to risky companies and they've had some nasty blowups in the past. I would by no means consider these to be safe. An interesting quirk is that they're typically floating rate bonds, meaning that the lender isn't paying a fixed rate on their debt. They're paying a spread over some set benchmark, and if that benchmark rate goes up, they have to pay more. In most environments over the past 15 years, when rates have been really low, these have offered lower return and a similar risk profile to high yield bonds, so not very attractive. But in the event that you ever expect rising interest rates, these can help protect against some of the losses that you might see from other high yield bonds. Right now, in September 2024, since interest rates have gone up so much over the past few years, a lot of leveraged loan funds actually yield a little bit more than high yield bond funds, often in the 9 or 10% range. However, that's poised to go down if interest rates fall over the next few years, which isn't exactly a unique insight. Currently, these funds are experiencing record outflows because many people fear a recession and falling interest rates, which could be a pretty challenging environment for them. The final area of high yield bonds we'll cover is private credit. Honestly, I don't even know where to put the dot on this one because the details of these strategies are so opaque. Here's what I do know. Usually, it's private lending to small, risky companies. Often, they pay even higher yields because it's hard for them to get a loan anywhere else. And this market has been growing so fast that yields and lending standards have been coming down. This reminds me of the subprime mortgage market in the mid 2000s, which we all know eventually blew up. There are certainly some key differences, so it's not a perfect comparison, but a really opaque, new, fast growing industry that lends to risky companies where lending standards are falling due to high investor demand definitely makes me nervous. I wouldn't say that's a reason to avoid private credit entirely, but I would definitely suggest doing your thorough due diligence on whatever private credit product you're considering investing in. One final comment to make with respect to all of these high yield bond strategies is that, in my opinion, it's best to go active in this area. The key distinction between stock and bond indexes is that whereas stock indexes invest the most money in the largest companies, bond indexes invest the most money in the most indebted companies. Imagine you were going to lend money to one of your friends. Is that how you would choose which one? The one that already had the most debt? No, of course not. That's insane, right? So then why would you want to invest in an index fund that does that? In general, active managers have had a much higher success rate in bonds than stocks. The third retirement income strategy we'll cover is business development companies. These are essentially closed end funds that invest in small, risky, often private companies that are either in an early stage of development or financially distressed in some way. Unlike the portfolio managers of the typical mutual fund or ETF, they take a more hands on approach to help these companies out, more like what a venture capital or a private equity investor would do. Usually, the investing they do in these companies is either through some sort of lending or preferred stock. So it's mostly income generating investments. And they have to distribute 90% of their profits to investors, so people like them for their high yields. As an asset class, these can certainly offer high potential returns and high yields, with some growth potential. However, their use of leverage and combination of high liquidity for investors but low liquidity underlying investments is a dangerous combination that can leave them prone to significant downside risk. Think about it this way. A lot of these trade on an exchange like a stock. All the investors can sell out at any time. However, unlike most funds that own things like treasuries or publicly traded stocks, which can be sold at any time to give investors their money back, these hold private companies that can't just be sold on a whim. So, if a lot of investors want to sell at one time, the leveraged buying plus illiquid underlying investments can go the other way really quickly. To me, this is not an attractive risk reward profile for a retirement income investor, but with the right due diligence, there are some BDCs out there that you can find that can play a small role in a retirement income portfolio. The next area we'll cover is REITs, real estate investment trusts. These invest in income producing real estate assets and usually manage them too. Like BDCs, they're usually traded on public exchanges like a stock, but sometimes they're private. Also, like BDCs, they have to distribute 90% of their profits to investors, so people like them for their high yields. There are two main types of REITs: equity REITs and mortgage REITs. Mortgage REITs, which are often just called MREITs for short, invest in mortgages or mortgage backed securities, so bonds essentially. These usually offer lower yields than equity REITs, and knowing my audience, I'm not going to spend that much more time on them here. For what it's worth, I'd plot them down here on the spectrum. Often low risk, not much potential to grow their income stream over time, but also not likely to deteriorate as fast as something that's susceptible to big downturns with capped recovery potential, like the things on the upper right. With equity REITs, which are far more common, there are many different categories, which will dictate how they perform over time. For example, commercial real estate is in a rough situation right now. You've probably seen plenty of fear mongering videos about it over the past year, so I don't need to rehash that here, but it's a vast oversimplification. Really, the weakness has been in offices specifically, as more and more businesses have been allowing their people to work from home. If half of your office building is vacant, you're not going to collect that much rent anymore. But, for example, a REIT that owns data centers or apartments where rents have been going up a lot, or self storage facilities, would probably be doing quite a bit better. It's really not that different from investing in the various sectors of the stock market where, at any given time, tech stocks might be doing better than utilities and energy companies, or vice versa. Broadly, REITs offer an equity like return profile that has historically not been that correlated with the stock market, meaning it doesn't always go up and down at the same time. That can make REITs a really nice complement to traditional stocks and bonds in a retirement income portfolio. One key difference between REITs and most other stocks or stock mutual funds or ETFs is that they invest mostly in income producing securities, so they provide higher income. That means that if you're taking all of the income, your growth potential could be limited, but there is still some. Real estate can increase in value over time, generally not fast, but it can. And rents usually go up too, especially in an inflationary environment. For that reason, sometimes these can provide income protection over time, along with inflation, which is what we want when we're trying to create a sustainable income portfolio. To me, these are another high quality option as a portion of a retirement income portfolio. One word to the wise, though, I'm not sure how common this is anymore, but at least back in the day, there were some non traded REITs, so non publicly traded, that had crazy high fees and brokerage commissions in the 8% range. So I would just leave you with this. If you're working with an advisor who's recommending non traded REITs, make sure they have a really good reason for recommending the one that they're recommending. A high YTV, aka yield to broker, is not a good reason. The final area we'll touch on, and my personal favorite, is dividend income funds. They invest in diversified portfolios of stocks that pay out a portion of their earnings as dividends. Generally, they pay a lower yield than anything else we've talked about here, except for maybe some conservative M REITs. And generally, they're more tax efficient than anything else we've talked about here, except for high yield municipal bonds. Pretty much everything else has its yield taxed as ordinary income. Dividends from stocks are generally taxed at a lower rate, which maxes out at 20%, at least as of September 2024. They also have a lot of their returns come in the form of capital gains when you sell, which are also taxed at a lower rate if you've held onto your position for at least a year. That gives dividend income funds a more favorable tax profile than pretty much everything else we've talked about today. Compared to the broader stock market, dividend paying stocks, especially if they're stocks that consistently grow their dividends, tend to hold up better in downturns. Compared to other options here, I would argue that they give you the best chance to create a long term, sustainable income stream that will keep pace with inflation. No, it's not going to be in the 10% range, but nothing really offers that, in my opinion. Everyone is different, but if I were crafting a retirement income strategy, I would build it out of a combination of dividend paying stocks, REITs, and municipal bonds, and dividend paying stocks would be the core. If you want to sprinkle in any of the other things I've mentioned here, you could, but personally, I wouldn't. The number one lesson you should take away from this video is that when creating a retirement income stream, you need it to be able to grow over time so that your income will keep pace with inflation. The number two lesson is that yield doesn't matter. All of these ultra high income strategies are just asset gathering gimmicks. The two most important things when creating a retirement income strategy are volatility and total return. Volatility matters because the more you lose, the harder it is to recover. And that's exacerbated when you're taking income because if the total return of your investments is, say, minus 10%, and you take out 5% as income, the actual value of your portfolio falls by 15%. There's also less total return available the next year to help make up for your losses. Because if your investments earn a total return of 15% and you take out 5%, the value of your portfolio only goes up by 10%. It's a vicious cycle, and as you can see from the chart, every little bit you lose requires exponentially more return to make up for it. Total return is important because if you have $1 in your account, you can create $1 of income. Simple as that. If you don't, you can't. The relentless focus on yield is misplaced. If your account value is falling over time, your actual dividend payments in dollars will be falling over time, even if the percentage yield remains the same. You can't buy groceries with percentages. If you're investing in something really risky, like a single stock covered call ETF, and you're taking out all the income, it probably won't take more than a couple years for your portfolio value to be significantly lower than where it started. You may still be getting a 70% yield, but it'll be on a much lower base. Thus, your actual income will fall. Ultimately, volatility and total return are what really matters, because if your portfolio value is zero, it won't matter if you've got a 10% yield or a 1,000% yield. 1,000% of zero is still zero. So, the best long term sustainable approach is to build a diversified, tax efficient portfolio that can generate a high enough return with low enough risk to meet your goals. The income doesn't matter because all of these income products, to varying degrees, create highly variable and unpredictable income streams. It's much better to simply set everything to reinvest all the dividends and then take out systematic withdrawals of however much you need. That allows you to create a consistent income stream based on how much you actually need to pay your bills and support your lifestyle. As a general rule, 4 to 5% annual withdrawal rate is what's considered sustainable in the long run, but obviously it depends on what you've invested in. If it's short-term treasuries that are paying 2%, you probably can't take out 4 or 5%, so forth and so on. If you're okay with your money running out over a 30 or 40-year period, you may be able to take out a little more than that 4 or 5% general rule, but that's what I've got to leave you with here since I don't know your personal situation and I can't give advice on this channel. For most people, it's better to consult with a financial advisor to help you craft a specific plan to your needs. But I hope this has been a helpful general overview of the options out there and how they compare to each other. If you enjoyed this video, hit that like button, leave a comment with what you want us to cover next, and be sure to subscribe so you won't miss it. And if you want to continue the investment conversation with my partner Kyle and I, you can click the link in the description to join our Discord, which is free as I'm recording this, but may not stay that way forever. Thank you for watching, and we'll see you in the next video.